An appraisal is a professional evaluation of a property's value, typically required by lenders to determine loan amounts. And there's, different lenders do different things in terms of evaluating property value, but I'd say the appraisal is still the most common method. And this is extremely important in private lending, extremely important. Like, we don't do any files without an appraisal in place.
This is also everything in real estate investing. If you don't have a good appraiser on your side, you are toast. Like a wink, wink, nudge, nudge.
Yeah.
But you need someone who can work with you, can see your vision, and then can also help to sell that to the bank. Hey everyone, thanks for tuning into the Canadian Private Lenders Podcast, a show covering the private lending industry, the mortgage broker space, and the Canadian economy. Your hosts are Neal Andreino and Ryan MacNeil. Enjoy.
All right, everybody, welcome back. It's episode 76 of the Canadian Private Lenders Podcast with your hosts, Ryan and Neal. Neal, how you making out, buddy?
Good. Just had a coffee, so I feel like I'm all fired
Let's go.
up.
Let's go.
Don't drink caffeine often, as you guys know, or some of my buddies would know.
I drink it 24/7.
Yeah. But
well. So, Neal, today we're going to jump into some mortgage definitions. We've kind of hinted at this in previous episodes. Feel like we're often skipping over a lot of things that we just assume everybody knows, but there's some important things to define out there. So we're going to get into that.
Let's do it. If you already know all of these, you still have to listen. So
you still have to listen, yeah. And just on that note, let's. Do you want to kick it off with any news? We haven't been together in a little while, but there's been a lot on the go. We got an election coming up in a couple of weeks.
How long do I have? So
go on it.
Okay,
get into it.
Do I want to get into all this? The capital gains tax proposal. Let's talk about that really quickly. Okay. So I'm sure everyone who's listening to this is in real estate, so they probably all saw it.
Maybe.
But there's the proposal for the idea from Pierre that he would create a similar setup to the 1031 exchange in the States, which is when you sell, instead of paying a big capital gains tax, you have the option to reinvest the money into maybe Canadian real estate and other industries. Obviously, it hasn't been fully flushed out yet. But as long as the money gets reinvested in the Canadian economy, you will be exempt from tax.
Yeah. It's a big move.
It's a huge move. And I think he's trying to draw back a lot of people who were like, Mark Carney's the economist.
The central liberals.
The central liberals.
They're flowing back to Carney.
Yeah, exactly. Yeah. And a lot of real estate guys, because I know a lot of real estate guys are starting to be like, well, Carney will probably be better for immigration, which ultimately is what we need to keep the real estate market alive.
Yeah.
Maybe what's your take? How do you think that'll impact the marketplace?
The proposal from Polyev?
Yeah.
Is that what you meant?
Yes.
Yeah, the 1031. Yeah. I mean, it's bold enough that it's going to get some attention. Some real estate influencers were pretty excited about it. I saw in the last couple of days. Is it too late? I don't know. It's crazy. What I wanted to point out here is that when we were sitting down here 4 weeks ago, and I think Carney had just been named Liberal leader, we talked maybe this is going to mean not a conservative majority in this election. Maybe it'll be a conservative minority. If you believe the polls now, and I was just talking to a broker about this yesterday in Ontario, it's hard to believe how much the mindset has changed so quickly. And I don't know, was it an absolutely brilliant play by Trudeau on how he exited and then made the transition to Carney, and he's like the perfect guy to get those kind of central-leaning liberals to swing back to the liberal side rather than going conservative this election? Or is it Polyev shooting himself in the foot and not being aggressive enough? Like, what do you think it is here? Like, it's kind of hard to believe how far it swung.
So I'm going to start with, I don't know if it was Trudeau's play, but I think the Liberals.
A lot of the speculation, like they're longtime buddies or whatever, right? And clearly that was Trudeau's guy that he wanted to succeed him, right? And the fact that, he was sinking the ship and got out, in enough time to name a Liberal leader. And it's clearly swung the pendulum significantly.
That I don't disagree with. And so that's what I think they did was genius by the Liberals, is everybody in the Liberal camp is getting tired of what was going on, and they were starting to lose even their most diehard fans.
Yep.
They were all standing on the fence, like you said, the central Liberals. And the big thing that was kind of drawing them towards the Pierre side or the conservative side was that we need help with our economy, and that's going to be what Pierre does. Mm-hmm. And so they were really smart in choosing Carney to be the next guy, because now everyone just went right back immediately, because like, Carney's an economist. He's part of with the BOC. He's done all these things, like blah, 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 blah. And he's going to be the perfect fit to save us from that. And so it took away that one bit of doubt that they had in their mind and brought them back. To your point about Pierre not being aggressive enough, I think my disappointment is, and like onto what I am right now to even make my decision.
I agree.
I get a lot of negative feedback on who Carney is and obviously what's gone on with the Liberals. But at the same time, I also respect that there's been a lot that's gone on in the world economy that really had nothing to do with who was in party. And then at the same time, my problem with Pierre is right now or the Conservative Party is, I don't think they're doing a good job in the marketing that they're offering, because ultimately it's a marketing game. And I want to, again, I am conservative and I want to love that party and I want to love Pierre. For whatever reason, their marketing campaigns are actually turning me off a little bit in the fact that they almost feel combative and almost like a little bit like,
yeah, it's not the play right now.
It's not the play. They're not inspiring me. Like, I'm not feeling inspired ever from the ads. I listened to the Jordan Peterson podcast with Pierre, wanting to come out of it feeling really inspired, and I didn't. And I feel like, I don't know, for some reason he's not resonating with the people. Like, nobody I know all the conservatives are like hardcore conservative, and that's why they're voting conservative, but they don't really tell a story about Pierre that sounds inspiring or has any reason for me to want to get involved.
Yeah.
And so I think that needs to be done better. And right now it's already starting to be like the Conservatives are responding to the Liberals, which creates the perspective that the Liberals are actually already back in the lead when they have to make response articles, response media.
Yeah.
That would be them saying like, okay, well, now we're responding to Liberals, who is the main leading party.
Yeah.
Which technically they kind of weren't there only 3 months ago.
Yeah.
So all to say where it's going to go, I have no idea. And I'm like so 50-50. And who I really support, I'm also, I'll say dead center, because I don't feel educated enough on either party to really make a good, proper decision.
Yeah, I completely agree with that, Neal. I'm very much uncertain which way I'm leaning right now, and need to be educated further. But it kind of blows my mind that the conservative strategy when Trudeau was still in power, it seemed to make a lot of sense, just kind of sitting back and let him continue shooting himself in the foot.
Yeah.
But now that's just not the case, and it's hard to believe, in such an important election, how much the polls have swung in such a short period of time, right? So,
totally.
And maybe, we still got just under 4 weeks now, I think, until the election. There's still, lots of time for things to change. And maybe those polls aren't exactly correct either. I almost find it hard to believe it swung that much, but I guess we'll see.
Yeah. Yeah. It feels like it on the street. But
and I know the Liberals have been out aggressively in my neighborhood, at least.
Really?
Yeah. It's a Liberal seat in my neighborhood, but
okay.
So the incumbents Lib talk for today. Where should we start here, Neal? Should we just go? I think we're kind of like alphabetical order here for the most part. So do you want to kick it off with the first one?
Yeah, we can go back and forth here. So the number one that we have is amortization. You guys have probably heard us say this a few times, not a ton of times, because in private it's not nearly as crucial.
For sure.
But the definition of amortization is it's the length of time it takes to fully repay a loan through regular payments of principal and interest. So for most people, the number you think of is 25 years. That is kind of like the standard in Canada. You will see some 30-year periods as well available, sometimes on the res side, more so on the commercial. Insured loans commercially on CMHC can go 40, even 50 years.
Yep.
And so that's been a big part of saving our market with debt servicing.
Totally.
But you can even, sometimes, some people are so aggressive and hate having debt that they will shorten their home loans. And you'll hear people who have 10, 15, 20-year home loans, but that is the time that it takes. That's how long you're stretching your loan out over. Absolutely.
And I think just a couple comments there. The 30-year AM is now available for first-time buyers, if I'm not mistaken. I can't remember all the rule changes, but of course, as you mentioned, Neal, not as relevant with private lending because private lenders typically offer interest-only loans, which actually means there's no amortization.
Non-amortizing loans.
Yeah. And that sometimes confuses brokers. They're just, I still get the question all the time, even from experienced brokers. They're just like, well, what's the amortization here? And you'd have to explain, well, there actually isn't an amortization period here. It's just you're only paying the interest portion on most private loans, although we've seen some private lenders that do P&I as well.
Yep.
Next up, appraisal. So very important one here. You've likely heard this before, but just to define it, an appraisal is a professional evaluation of a property's value, typically required by lenders to determine loan amounts. And there's, different lenders do different things in terms of evaluating property value, but I'd say the appraisal is still the most common method. And this is extremely important in private lending, extremely important. Like we don't do any files without an appraisal in place.
This is also everything in real estate investing. If you don't have a good appraiser on your side, you are toast. Like a wink, wink, nudge, nudge.
Yeah.
But you need someone who can work with you, can see your vision, and then can also help to sell that to the bank.
I would say the same thing from a private lender perspective. You want to make sure you're working with the right people here with licensed, accredited appraisers because it's, as my dad used to call it in the game, the boogeyman that you deal with because you're basing it on someone's opinion what the actual value is, right? We're not always dealing in purchases. We're often dealing in refinances. And lending, of course, is to ensure that loan-to-value ratios are maintained. And we're going to define loan-to-value here as well once we get into it in a couple definitions from now.
Yeah. Number 3 we have is bridge loan. This is a term that you definitely hear us say all the time because it's a type of loan that we like to do and a lot of privates will do. And oftentimes some of the bigger banks won't unless they already have an existing relationship with that client. And it provides a good marketplace for privates to get involved. And so a bridge loan is short-term financing that helps borrowers transition between properties. So for example, you are trying to sell your house, but it's a stressful thing because you're like, well, I got to buy this other house as well. And sometimes the timing doesn't line up perfectly where you have to buy the house before your house is sold, but you have all the equity in your previous home to buy that next one. And exactly, your main lender won't say, yeah, sure, I'm going to get you do both homes. So in the short term, you're like, well, I know this money's going to come, so I'm going to take the money out of my current home, utilizing a private to pay for that next one.
Yep.
So, and again, it's a private space. Usually, sometimes if you're fortunate and then the dates line up and they're not that far apart, your main lender will also take it on. But this is a great marketplace for privates. It's almost, I don't want to say it's a guaranteed exit strategy, but it's a good way to make money.
Absolutely. Next up, collateral charge or collateral mortgage. Higher amount, the same charge. So basically the lawyer who is putting this deal together will actually register that mortgage for a higher amount than the actual loan. And this can provide flexibility. I know lenders like Scotiabank also offer this type of collateral charge. I believe it's called a Scotia Step Mortgage, where there's a chance to readvance a higher amount at a later date. And private lenders often use this for flexibility for additional financing, basically in the same way.
Yeah, I was going to say sometimes you'll see lenders register $1 million even though the loan's only $500,000, but that allows them, if you need to get a construction draw for $250,000, they can just do that because they're already have the coverage locked in on your property.
Absolutely.
So, next one
next one here is construction draw. So we talk a lot about construction mortgages. We offer construction mortgages at Keystone. Some private lenders do, some private lenders don't. But basically, it's quite straightforward. It's basically a staged funding structure where funds are advanced as construction progresses. So often on a construction loan, you'll have a 3-draw or a 4-draw structure. We often do, at the weather tight stage, basically when windows and doors are in, the roof is tight, we advance, somewhere around 40% of the loan. And then you get to, maybe the drywall stage and another 30% of the loan when you're around 60, 70% complete. And then the final draw is typically, you're 90+% complete, and you get those remaining funds at that point. So private lenders, of course, play a role in the faster release of funds compared to traditional lenders, which is one reason that often that builders and developers like to use private financing on construction builds for the simplicity and flexibility there.
And just a side note, guys, we're just hammering through these nice and fast to try and keep it interesting. And if you want to go over something, hit it back. Or if you're curious with more detail, just shoot us a message and we can flush it out more. But the intention here is to just give you a lot of info really quickly while you're maybe doing some work or driving. So number 6 is debt service ratios. We have TDS and GDS, gross debt service and total debt service. Gross debt service is defined as the percentage of income used for housing costs, your mortgage, your property, your tax, and your heat. Total debt service is a percentage of your income covering all debts. Private lenders typically aren't as hung up on these because the idea is that there's usually an exit to pay the full amount out, where it's not an amortizing loan, where the expectation is that you're not going to be with them for more than 12 to 24 months. These things become less important because they're looking at like, okay, you have a sum of money to service this, or you have a big piece of cash coming, whether it's a sale of property, sale of a business, sale of an automobile, that's going to pay this out. But these things are very important for regular amortizing loans, and almost every other loan that you take, that's what they're looking at, is a coverage ratio to see how much money you have to cover. And that's where you hear the terms like stress test, is they're looking at this and they're ramping up, they're elevating it above where it sits right now to make sure that you have the ability to debt service in the event of interest rate hikes or potentially your income going down.
Absolutely. Much less important in private lending. And as one very successful private lender once told me, he can blast the ratios into the sun, just doesn't care about them whatsoever. The only time it's really relevant on the private side is if the exit strategy is dependent on the ratios being in line, right? Yep. But there's often situations in private where you're dealing with someone who's self-employed, who doesn't claim a lot of income, and therefore the ratios are blown up, right? So, yep. But you got to listen to the story more so on the alt side. Next up, equity. Equity, big piece of the puzzle in private lending. So definition of equity, the difference between the property's value and the amount owed on it. Quite straightforward, okay? So private lenders rely heavily on equity in the property rather than income for lending decisions, as we kind of just mentioned there, right? So where you're going to jump in, Neal? Go for it.
I'm just laughing because I just watched The Wolf of Wall Street there a couple nights ago.
Yeah.
I don't know if anyone remembers the scene when he's like, it's a fugazi, it's a fugazi. When he does that.
Yeah.
And I'm like, that's equity, and sometimes can be a little fugazi fugazi. Now, as a private lender, you're looking
back
for
to the appraisal.
It comes back to the appraisal, exactly.
Yeah.
So you're looking for real equity, but
yeah, you want real equity, but there's different ways to look at it too, right? You might have equity in the form of additional security on other property or properties, is right. So it typically plays a factor, but where the bank is willing to lend 80% or 90% or 95% with that smaller equity piece, private lenders are more in the 65 to maybe 75% loan to value range, and increasing that equity buffer.
Number 8 is fix and flip loans, or BRRRR loans. I'm sure a bunch of you guys know what BRRRR is: buy, rehab, rent, refinance, and repeat. But basically, these are short-term loans designed to help you get into a property like this, get the work done, provide the loan to get that work done, and then allow you to get out of it, whether it's through a refinance or a sale. Again, private lenders are very ideal for these, and a lot of banks don't really want to get involved because they can be a little bit administration heavy, and they're not easy for an appraiser to value. Typically, there's some nuance, and they'll look for the stabilized property. But during the process, a private lender is really your best option.
Absolutely, yeah. We love these types of loans. And to your point, Neal, the banks don't love the complexity of this types of loans. And like you said, that's a good point, having, materials on site. They'd have to make judgment calls on, how much to advance in a given construction or renovation draw, right? So a great fit for private lenders.
Exactly.
Interest adjustments. So basically, this is defined as the interest charged from the closing date to the start of the first full mortgage payment period. So when you close a mortgage, you don't actually pay interest on, if your payment's on the first day of the month, like a lot of lenders do, you don't actually pay that first payment. There's just an interest adjustment period at closing that covers that interest window, and then the following month is when you'd actually start paying your full monthly payments. So
first month's all fun.
It's all fun and games, exactly.
Free money.
Yep. It often applies when closing doesn't align with standard payments dates, right? So if you don't align to that exact date, then you're going to have an interest adjustment on the close of your mortgage.
Month 2 sucks when that payment comes out.
Absolutely.
Number 10 is
Unless
LTV.
you're the lender.
Number 10 is LTV, loan to value. Don't feel bad because the amount of money that you box and you owe $750,000, your formalized loan to value is 75%.
Mm-hmm.
This is extremely important because you will see these terms all over the place, and they do really dictate when you're doing your calculations, doing your analysis. You need to kind of have these in your head, because even if all the numbers are perfect, it doesn't really matter. Like, there's only certain loan to values that you can get. So even if you can debt service $1 million loan on a $500,000 property, it doesn't make a difference. If it's only worth $500,000, they're going to still cap you out at a specific loan to value.
Yep.
The average in commercial world is 75%. Insured loans with CMHC can go as high as 85 and 95%. Mm-hmm. Even on refinance, there is some stipulations with that, but it's good in the commercial world. You should be basing your stuff off 75. Once you get into high value new construction, that's a different story. And you start looking at the 85 to 95% loan to values.
Exactly. And while the typical approach to loan to value calculation is the loan amount divided by the appraised value, often lenders will use the purchase price, especially if the purchase price is lower than that appraised value. They're going to be more conservative there. And another thing to consider with loan to value too is, say, on a construction or renovation loan where there's an as is or current value and also an as complete value or loan, the date when the mortgage term ends requiring renewal or full repayment. Okay. And I think next episode, we're actually going to talk about renewal with private loans. But obviously, this is very important in knowing your renewal options, specifically with private lenders. This is something, if you're dealing with a broker, to, not reach out to them a week before your maturity date. You want to be proactive and reach out a month or two before to determine what your options are and what it would cost you to fully repay the loan.
100%. Mortgage discharge. You probably hear us say this as well. It's pretty obvious, but the process of removing a mortgage from the property title once the loan is repaid. Some private lenders and regular lenders will sometimes have discharge fees associated with the loan. One thing to consider, and I've seen this more with smaller lenders, is making sure that it actually, or smaller lawyers maybe, is making sure it actually gets discharged. I don't know how many times and even actually gets registered. How many times I've seen loans not get registered or discharged, and I'll only find out like 2 years later or 5 years later when I go to do a refinance, I go to sell the property, and they're like, it still shows you have a loan from so and so, and it's a minor panic attack because I'm like, no, I paid them out like 4 years ago, and they're like, well, they still show on title. But anyways, it's not a big deal. Usually you can get it cleaned up at that point in time, but it's worthwhile making sure you have a lawyer that's on top of it and keeping tabs on that, because you don't want to have a bunch of stuff on your title.
Yeah, that can lead to some heated discussions and some stressful moments. When you're like, I thought I paid that off.
You're like, wait a second, how much money?
Yeah, exactly. Next up, mortgagee and mortgagor. This used to confuse me for years, but a mortgagee is the lender providing the loan, and the mortgagor is the borrower receiving the loan. Right? Mm-hmm. So obviously a key distinction in private lending agreements, those two will be clearly outlined.
Number 14, mortgage term. So this is a confusing one when you think about mortgage term and amortization. So the term is the actual period that you're signing on. You hear these 2-year terms, 5-year terms. That's not the full length of the mortgage. Again, the mortgage is amortizing over 25 years. The term is the period of the mortgage. What we have in here, period for which the mortgage agreement is in effect before renewal is needed. So typically you can lock in a rate for that period, that term. But that term, again, does not run the entire length of the amortization or the entire length of the mortgage.
Yep.
So just, again, it's easy to sometimes get those confused. But private lending, typically shorter to like 6 months to 24 months. And then again, your big five are usually between 3 to 5 years. And in the commercial world, sometimes you can get a term as long as 10 years.
Yep.
And then in the States, you hear of 25-year mortgage terms where they literally lock in their rate for their entire length of their mortgage, which is unbelievable.
Yep.
But yeah, that's
Different
what a term
worlds.
is.
Yep. Very good. Okay, number 15, open or closed term. So very straightforward here again. So an open term allows early repayment of the loan without any penalties. And you don't often see this on any longer term loans. It's typically a 1 year or less, likely at a higher rate as well. We offer open term mortgages. I know a lot of private lenders do. A lot of private lenders don't as well. And the opposite side of that, of course, is a closed mortgage, which is much more commonplace amongst traditional lenders, but even some private lenders as well. And this has restrictions or penalties on early repayment. Oftentimes, it's a 3-month interest penalty, so it's quite significant, right? So something really to think about. If you require a short-term loan, it may be worth considering an open term.
Once you factor your penalties.
Exactly. Worth doing that calculation every time.
Similar concept that we're going to talk about number 16 here is prepayment privilege. Now, we're talking about portional prepayment, not the entire loan. And so that's the ability to make extra payments on a mortgage without penalties in advance of the term being complete. You'll see this oftentimes with, again, your big five, where they'll say every year you have the ability to prepay up to, I think they say like $25,000 or $50,000. They usually put a dollar amount on a percentage. And so they say, well, if you want to expedite paying down your home, you can do this. And again, it's not a bad idea, but again, my thing is if you're borrowing the money at 3-4%, I don't know if I do the prepayment or invest the money, but that everyone has their own priorities. That being said, you don't see this typically with privates, again, because the loans just aren't long enough where it makes a ton of sense. But on a renewal, oftentimes a private wouldn't be opposed to seeing you pay down a period. It would actually probably help your ability to get a renewal with a private. If you said, hey, look, I'm going to pay it down $100,000, then can you guys give me an extra 12 months? They're more likely to say yes because you're helping to keep them on side of the same period.
Yep, absolutely. Next up, principal. So basically, principal is the loan amount. It's the original amount borrowed before any interest is paid, okay? So, of course, we've mentioned it already, but in private lending, often it's an interest-only loan, so you're actually not paying down any of the principal. So the only time you build equity by paying down the principal is when you're making principal plus interest payments. And that principal tends to increase over the life of the term.
Number 17 is a quick close. I mean, I think that's pretty obvious, but a mortgage that needs to be funded within days rather than weeks. This is looking at it from the aspect of a mortgagee. For a mortgagor, it's you're trying to close that property fast, so you need that money quick. This is, again, where private lenders specializes in these situations because they can underwrite quickly. They can move funds very quickly. There's not a huge stack of people it needs to go through. Versus, again, some of the bigger banks, it takes a little longer for them to get through all their underwriting processes before they can actually allocate you the funds.
Absolutely. Just a couple more to go here. So next up, refinance. So refinance is simply replacing an existing mortgage with a new one typically to access equity or to get lower rates. Those are typically the two main reasons you'd seek out a refinance. Private lenders often do refinances. I'd say, over half of our book is a refinance. of some sort. And private lenders also would be used, maybe in the improving cash flow situation or debt consolidation, or any short-term needs are required for renovations or relocation type loan.
Second mortgages, pretty obvious, but it's the mortgage registered behind the first mortgage. It's often used to get extra funds in a short period of time. Typically, if people have a bunch of equity and they might have a locked-in term on their first loan, they can't change that, or they need the money faster than that original bank can offer it, they'll take a second mortgage behind that. It comes with a much higher rate, but it allows them to get that cash in the short period of time that they're going to need it.
Yeah, it comes with the much higher rate as well due to the inherent risk with being in second position on a mortgage. That would mean if there was ever a default situation with the mortgagee or mortgagor? Mortgagee?
The mortgagor.
Mortgagor, yes. Oh, I haven't listened to myself here. Brutal. Yeah, so anyway, so they would, if there was a default situation, the first mortgage holder would have priority over getting their funds back, and then the second mortgage, of course, in second position.
Yes.
And last but not least, title and title insurance. So very important in lending in general, especially with private lending. So title is actually legal ownership of a property, where title insurance actually protects the owners and lenders from title-related issues such as fraud, unpaid liens, or any legal disputes on the property. Okay. And this is often required in private lending transactions. We require it on every single transaction.
I feel like every deal for everyone always has it. I feel like I've been paying into it for 100 years.
Right?
Yeah.
Pretty standard.
100%.
You can't really get around it. And if your lender isn't looking for that, that's probably a flag.
Yeah.
Right?
Or maybe you're just getting off easy.
I think we covered the ones we wanted to. As to your point, anybody who wanted additional things defined that we may have missed, we didn't cover all, there's hundreds of mortgage terms out there, right? We thought these were most relevant to private and alternative lending, but please do let us know, or please let us know if you want us to expand on any of these definitions.
Exactly. And if you listen to the political banter at the start and you're still heated and still listening at this point, feel free to shoot me a message and tell me your take.
Yeah.
Again, I'm not siding with anyone at this point in time. And so I'm open, I'm ripe.
Absolutely. As mentioned, next episode, we're going to chat about what happens at maturity of a private mortgage. So please do tune into that. Please subscribe and leave a review and share this with your network as well. Thanks for listening.
Thanks for listening, guys. It's Neal, your co-host and co-founder at Keystone Mortgage Investment Corp and Director of Investor Relations. I'm also a real estate agent, real estate investor, and business owner.
And your co-host and co-founder of Keystone Mortgage Investment Corporation, Ryan MacNeil. Keystone MIC is licensed under the Mortgage Regulations Act of Nova Scotia, license number 3000844, and through FCMB, license 89280. Keep in mind, the views of this podcast are for informational purposes only and are not financial advice.